Hi, everyone. Thank you for joining today's webinar, What to Look For and Look Out For in Quantitative Investing. Today's speaker is Gary Antonacci. Gary is recognized as the foremost authority on the practical applications of momentum investing and optimal system development. He is the author of the award-winning book, Dual Momentum Investing. In 2012, Gary was the first place winner of the prestigious Wagner Award for Advances in Active Investment Management, given annually by the National Association of Active Investment Managers. He received his MBA degree from Harvard Business School. Thanks, Gary.
Thank you, Paige. Thank you, everyone, for attending. We're going to be talking about what to look for and what to look out for in quantitative investing. So let's jump in with an example. This is an exact prediction of the S&P 500 returns. The paper is on SSRN. And the authors are saying that the future trajectory of economic growth can predict the stock market. Real GDP is related to population growth, and population growth in the US can be represented by growth in the number of 9-year-olds in the population. Now here's a slide showing that. We see the S&P 500 as the clear circles and the number of 9-year-olds as the dark ones. Now the authors would like to submit this paper to a journal. What should they do first before submitting it? Go ahead and send in your answers. Don't be shy. What do you think they should do first before submitting their paper? All right, someone says do some out-of-sample testing. That's generally a very good idea. If they don't have US data, maybe they'll look at other countries. Anything else? Submit their paper to their peers and get some feedback. That's also a good idea, peer review. Some researchers recently sent me their papers when they posted it on SSRN to get some feedback from me. Let me tell you what they really should do with their paper. They should go camping and take it with them in case they run out of toilet paper. That's what their paper is good for. Come on now. The number of 9-year-olds and performance of the S&P 500. You can think of plenty of countries that have exploding populations and terrible stock markets. Moreover, this is only 12 years of data. Deming said, "In God we trust, all others bring data." Let's take a look at another example. Here we have the cumulative scale returns to the S&P from a market-neutral strategy. It was developed in 1963 to 1988 and was extended out of sample from 1989 through 2015. Shows even stronger performance out of sample. It has a high Sharpe Ratio, an annual alpha of 6%. During the financial crisis, it gained 50%. It has low turnover, low correlation to well-known factors. So how was this system developed? They took the stock symbol of the long position and searched through every letter of the alphabet to find the one they liked. They did the same on the short side. They say if you torture the data long enough, you'll get it to reveal anything. That's what we have an example of here. And many of you are probably familiar with overfitting the S&P 500 through this example of butter production in Bangladesh. Now, these are obvious spurious correlations. Well, maybe not the first one. I think I had some of you going on that. But think about it. What about all the systems out there that are not so obvious, that are basically doing the same thing? I get emails all the time from people developing those kinds of systems or trying to modify my systems. You see them all over the internet. There's even a website out there that tracks various quantitative trading approaches, and many of the systems are put together this way. So what do you need to do to make sure you don't fall into that trap? Because Developing strategies by data mining will lead to unreliable outcomes. So what you need to do, first of all, is make sure that what you have is logical. Does it fit in with what we know about the markets? And what do we know about stocks? Well, back in the 1950s and 60s, not very much. Financial economists had physics envy. They wanted finance to be more of a science. So they did some quick runs analysis and serial correlation tests and said that even though stocks drifted upwards over time, otherwise they fluctuated randomly. This became the random walk hypothesis, which soon evolved into the efficient market hypothesis. This says that because people are rational, an important assumption, that if there were any abnormal profits to be had, investors would arbitrage them away quickly. So the only thing that really makes sense is to hold the market. Now, this took hold of academic finance for over 30 years. And it wasn't until later that Nobel laureate Robert Shiller said, efficient market hypothesis is one of the most remarkable errors in the history of economic thought. And when did they begin to see the light? Well, it was in the 1980s. First, through the advent of behavioral finance, two psychologists, Tversky and Kahneman, showed that people could be consistently irrational and that could persist. And that's with all people, not just my ex-wife. Pause for laughter. They also discovered mean reversion, which goes against efficient markets. First on a short-term basis and long-term basis, and then intermediate term-wise, they discovered price continuation or momentum. For those who want to check it out, here are the papers evidencing that. And what does this mean for us in terms of model developers working with stocks? Well, it means if we want to have a trend following approach, we should be looking at look-back periods of 3 to 12 months, ideally. And if we want to do short-term trading, then we should be looking at a mean reversion approach to have the odds in our favor. There's also the problem of complication. Van Neumann said, give me 4 variables and I'll create an elephant. Give me 5 and I'll make it wiggle its trunk. So we should keep things simple if we can. Einstein said things must be made as simple as possible, but never simpler. Now, what do we do in the event of model overfitting, where we have multiple comparison biases? Well, there are a few papers out there that will identify false discovery rates and help us overcome that. This is important because the memory effect means that overfitting leads to losses, not just noise. Here's a checklist I put together of what we should be looking at as far as quantitative modeling. First, is it logical and consistent with what we know? Is it as simple as it can be? Now, sometimes we need to add complexity, some complexity, in order to make our model better, but we should always try to keep it simple. Academics call this being parsimonious. That's a word that makes them feel important. We should see, is it overfit? Have we checked that out? Have we done what we can to overcome it? We should also look to see if our model is robust. And what do we mean by that? Well, does it work in other markets? Is it consistent and persistent over time? If we have enough data, perhaps we can segment our results into decades and see how consistent it is. If we don't have a lot of data, we can at least split our results in half. Ideally, we would like to see both halves perform well, especially the second half. And what about the parameters? We would like to see some stability there. We don't want to see a sharp spike in one parameter. We prefer to see surrounding parameters also showing that they work. Next, is there enough data? Here's a chart that appeared in my book showing regimes going back in 15-year increments. We could see the last 15 years is considerably different from the 15 years before it. So if we develop a model on only 15 years of data, it may not hold up going forward if that regime changes. Ideally, we would like to have a model that performs well over the entire time frame. As far as trading costs, let's take a look at factor investing to gain some insight there. Factor investing has become very popular. Quantopian, they have some videos on factors so that you can incorporate it into your trading. Factor investing is up to about $1 trillion now. BlackRock has estimated it will go up to over $2 trillion before long. 87% of institutional investors are incorporating factors within their methodology. So let's look first at momentum. Momentum has shown itself to be the strongest factor. It's consistent, persistent, works in a number of different markets. But the thing about momentum is that it's a high turnover strategy. And momentum stocks tend to be volatile with wide bid-ask spreads. So academics wanted to take a look to see whether momentum would survive trading costs. And there have been a number of papers with respect to that. They all show that momentum does not survive trading costs very well. Fund sponsors were not very happy seeing these results, as you can imagine. So they got together their own researchers, much like the tobacco companies did when the Surgeon General came out saying smoking was bad for you. And they came out saying trading costs are not too high. Now, I'll leave it to you to make up your own mind. The research is out there. You can go to my blog to read more about it. But disregarding trading costs, there have been some research showing that momentum profits have disappeared since the 1990s. That was in 1993 that Jagadish and Tipman came out with their seminal paper on momentum. So that would seem to imply that post-publication, momentum profits have declined. Let's take a look at small cap, the size effect. Does size matter? 1982, Bands came out with his paper showing there was a small cap premium. However, since then, the research has shown that there is no small cap premium. So how can both be true? Well, when Bands did his research, the CRISP database he used had a survivorship bias in it. And once you adjust for that, then there is no more small cap premium. Some people argue that small cap is still useful when it's combined with other factors. We'll take a look at that next when we consider value. Value is the most popular factor. We all like that idea of going to a store and getting something for less money. Well, the market doesn't operate quite that way. It doesn't give away any free lunches. Here's some research conclusions by researchers who investigated the value premium. The value premium is virtually non-existent among large cap stocks. Market adjusted return to value within large caps is not reliably different from zero, and there is little evidence that such strategies deliver superior investment performance. This is not just looking at book to market. This is looking at all other value metrics as well. Yet most of the value funds you see out there are large cap ones. Maybe they don't read the research. The value premium exists mostly among microcaps. And here's a representation of the trading costs of the smallest microcap index stocks, from 3%, almost 8% in spreads to trade microcaps. So if there were profits there, they wouldn't survive very long, would they? Here's an interesting study by Laughlin and Howe. What they did was they ranked all the existing funds out there by book to market. The top 25% they called value funds. The bottom 25% were growth funds. And they looked at the difference between value and growth performance year by year from 1965 through 2001. And what they found was that value had outperformed growth in large caps, but by only 0.11% per year, which is meaningless. In the small cap area, they were expecting to see more outperformance of value over growth, and instead they saw the opposite. Value underperformed growth by 0.42% per year. And they attributed that underperformance to the impact of trading costs. Here's a quote by Charlie Munger. This is Warren Buffett's right-hand man. Doesn't look like he's too enamored with value investing. Here's a study done looking at 120 some anomalies that appear in the academic literature, both pre-publication and post-publication. Pre-publication, the mean gross return from these factors, that's long, short, each of them, was a gross return of 66 basis points. After trading costs, came to 9 basis points. Post-publication, the gross return dropped in half, and after trading costs, it dropped to 2 basis points. Now, I'm not saying to ignore factors. There may be some way you can come up to use them. I did myself by applying momentum to geographically diversified stock indices where there's very low trading costs and where research has shown they perform best. I'm just saying, be careful and cautious. So now let's take a look at some of the ways to evaluate trading systems. The most common is the Sharpe Ratio, where we look at excess return divided by standard deviation. It gives a good approximation to the efficiency of whatever we're looking at because it's standardized return with respect to volatility. There are some issues, though, pertaining to the Sharpe Ratio. First of all, it only looks at the first and second moments of the distribution, the return and the standard deviation. Investors are also concerned with the third and fourth moments, the skewness and kurtosis. We prefer to have positive skewness, which means less tail risk, and low kurtosis. Kurtosis is how fat the tails are. In fact, the Sharpe Ratio was really designed to be representative if you have normally distributed returns or if your utility function is quadratic. Now, in the world of finance, we're not dealing with normally distributed functions. And quadratic utility implies decreasing absolute risk aversion. This means the more wealth you have, the more risk averse you become, which is unrealistic. Some sophisticated investors prefer a different utility function. Exponential, where you have constant absolute risk aversion, or logarithmic, where you have increasing absolute risk aversion. Furthermore, there are problems with selection bias, overfitting, etc. So there is a way to adjust for that. Here's a reference for you that will tell you how to deflate the Sharpe ratio to make it a little more accurate. However, what all these ratios ignore explicitly is the left tail of the distribution. And investors tend to become more risk averse when they're under stress. So I always like to look at the drawdown distribution, no matter what other metrics I'm using. Now, the good folks at Quantopian looked at the Sharpe ratio in the systems that they have that people submitted to them. They wanted to see what actually performed best out of sample. And they found little value in the Sharpe ratio. They found instead volatility and maximum drawdown were more representative of future performance. So what to do? Well, you know, when you do a multivariate regression, you're supposed to not just look at the statistics, the coefficient p-values, the r-squared, the f-test, etc. You're also supposed to look at the plot of the residuals. Picture can tell you more than 1,000 words. So let me show you a picture of the dual momentum strategy that's featured in my book. It's a simple strategy designed for the public, in which I use a 12-month look back for determining my momentum signals. Now I use 12 months for a variety of reasons. First, the Jagadish and Titman study showed the 12 months worked best. The Moskowitz seminal study on absolute momentum also showed 12-month look back works best. You have fewer trades, which means more tax advantages. 12 months has the highest serial correlation. And 12 months has the highest increase in terminal wealth compared to the other lookbacks. And it has the highest compound annual growth rate. Now, the compound annual growth rate is consistent with the other utility functions I mentioned, exponential, logarithmic. So there's a reason to like it there, too. Now, if you were to use a composite in order to get rid of bias in terms of your specification, you would be sacrificing 120 some basis points a year in return. There are other ways to get rid of that type of bias as well. You could just add another asset to the portfolio. That would get rid of not only that type of bias, but timing bias and style bias as well. But let's just say, for the sake of argument, that you wanted to reduce systematic bias by including more than one look back. Take a look at the second best performer. That's 6 months. Now, if you go down to the 1960s through the 1980s, you can see that 6 months outperformed 12 months during that long period of time. It's the only other look back that outperformed 12 months. So if you were going to have more than one look back, you would use the 12-month and the 6 months together. Now, I would not have known that except for this chart. The chart will tell you things that you would not see otherwise. So let's look at another couple of things that people often use or consider when they're doing quantitative investing. There comes the question of how do you balance your portfolio? How do you allocate resources to the positions that you have? And one of the oldest ways of doing that is mean variance optimization, as presented by Markowitz, where you're considering the return, the correlation, and the variance. So what you're looking for is an efficient frontier where you get the highest return for any given level of risk, or the lowest risk at any given level of return. There's some problems though. These inputs are unstable, especially the return matrix. And the covariance matrix, made up of the correlations and variances, becomes grossly inaccurate when you invert it. The small estimation errors get multiplied. So the more correlated the assets are that you have, the more unstable the inversion matrix is. And MVO fails most when it's needed the most for diversification. D. Miguel did a study in which he compared MVO and other approaches to just a simple equal weighting, and he found the equal weighting outperformed. Back in the 1980s, I started using mean variance optimization with the hedge funds that I manage, using different commodity traders. And I found that I was getting results that would go all over the place. So from a practical point of view, I had to switch over to a more Bayesian approach, integrate some of this information with other things. Now, what about simulations? You don't see these much in academic papers. Usually they appear when people have just a limited amount of data and they're desperate to show some results. Problem with simulations is that they work best when you're dealing with distributions that are well behaved. That's not the case in the financial world. Serial correlations especially can wreak havoc with simulations. So it's always better to have real data, and the more the better. So let's review what we've been talking about with respect to quantitative modeling. First, we want to know, is it logical and consistent with what we know about the markets? Is it as simple as it can be? Is it overfit? Is it robust? Is there enough data to draw conclusions that are meaningful? And is it effective after trading costs? Remember also, if you torture the data long enough, it will confess to anything. And as Richard Feynman said, the first principle is not to fool yourself, and you are the easiest person to fool. We also need to be humble with respect to whatever models that we're developing or using, and be flexible and willing to change. Some of the sacred cows of finance, like the capital asset pricing model, efficient market hypothesis, they've gone by the wayside now. You need to leave your ego, your biases, your prejudices, your opinions at the door whenever you do quantitative modeling. So we're going to finish up a little early here because I always get a lot of questions. And I just want to say that I wish you all the best in whatever quantitative endeavors you do. And may the alpha be with you.
Great. Thank you so much, Gary. So we are going to move on to the Q&A portion now. Gary, we've had a lot of questions come in. We'll get to as many questions as we can today. Thanks, guys.
First question is, how do you reposition? I use monthly repositioning. For what I do, it works best. Some people use quarterly, some funds semi-annually in order to cut back on trading costs. Trading costs is not an issue with what I do. Is a 12-month look back possibly data mining as opposed to multiple look backs? Well, all look backs are data mining. There's no way to get around data mining. The question is to minimize it. Now with the 12-month look back, it was discovered in 1937 by Cowles and Jones when they were looking at stocks, and it's held up well ever since. As I mentioned, it was the top one that was shown in stocks with Jagadish and Titman, and then in 58 different futures markets, it was the top one identified by Markowitz. So I think there's plenty of robustness there. If you want to go even further back in time, Graserman and Kamenicki took a 12-month look back all the way back to the beginning of the stock market in the 1600s and before then, and found it performed really well versus buy and hold. For GEM, how many stocks do you hold? We don't hold stocks. We deal with geographic stock indices. And in order to avoid selection bias, we want to be in all of them. So we'll be in either US stocks, as represented by the S&P 500 index, or in the rest of the world, as represented by the All-Country World Index by MSCI, ex-US. People who pick and choose different ones or use a narrow index not only have selection bias, but the results are not as good. Can you explain why you use a logarithmic scale? Well, that's standard when you're showing results over time. They would look pretty outrageous if you used an arithmetic scale. So in order to be a little more realistic and to show growth over time, you typically use log or semi-log scale. Black-Linderman. Okay, that's a modification of mean variance. And it's basically a Bayesian type approach where they're incorporating other information into it. And that's fine. People do resampling and other things too. But you still have problems with that. Someone once asked Markowitz what he does for his own personal investing. And he said he just splits his money between stocks and bonds. So here's the creator of the mean variance approach who doesn't even use it himself. How would I apply machine learning to quantitative investing? I'd say very carefully. Machine learning, you can refer to the different issues I've mentioned today, and you can apply it to that. Can you consider markets to undergo phase changes? I'm not sure what that means, but as I showed, over 15-year periods, you can have considerably different returns. So you need to be cognizant of that. I see a lot of things out on the internet where they are very happy, blissfully ignorant, and they'll develop an optimized system, sometimes a complicated one, where they'll look at 15 or 20 years of past data and think they have the Holy Grail. Well, they're just fooling themselves. Maybe by luck, they'll continue with it and do well, but I wouldn't bet on it. Didn't Warren Buffett say if markets were efficient, I'd be standing on a quarter and holding a tin cup? I don't know if he said that or not, but it's a good line. Did I ever consider running my own hedge fund or a trading firm? If not, why not? I actually ran my own hedge funds back in the 1980s. I realized I wasn't going to be the best trader out there, so I went out and found the best ones I could find. People like Paul Tudor Jones, Richard Dennis, Monroe Trout, Louis Bacon, John Henry, and I put them all together into hedge funds. And I optimized the portfolio using modern portfolio theory principles. That's how I gained my experience with MVO, and did very well. I was able to semi-retire after that. As for now, no, I'm an old guy. I don't want to get involved in day-to-day kinds of stuff. I prefer doing research and writing, and I do have proprietary dual momentum models that I license to a select few advisors, and they pay me a licensing fee, and I'm happy with that. How would you apply quantitative investing to cryptocurrencies? I actually did. I was a little late to the game. Back in 2017, I developed a model for crypto trading and did very, very well. Of course, you could have done anything then and done well. And during 2018, I was on the sidelines most of the time, while Bitcoin dropped 80% and other cryptos dropped more. Now, early this year, I decided to walk away from that market. The reason being the first principle I raised: there needs to be a logical basis behind what you do. And my analysis was cryptos, Bitcoin, which became a Bitcoin minimalist, but Bitcoin is recognized as either a store of value or a medium of exchange. And if it could continue to drop 80%, then it wasn't being very effective on either of those fronts. Also, I couldn't find any intrinsic value to cryptos. With stocks getting beaten way down, say where the P ratios are in the single figures, it's almost a guarantee that you're going to make money if you buy them, because through mean reversion, the P's are going to go back up to a more normal range. Even if that doesn't happen, earnings growth over time will ensure that you make money. Even with commodities, if they drop so far that the price is below what it costs to produce the commodity, it's going to not be produced for a while and the price will go up. But cryptos are a pure speculative market, and I'm not willing to make bets on investor sentiment. Probably get a bunch of haters out there from crypto people, but that's just my take on it. Next question. You showed momentum not working anymore and having high trading costs. Why do you use it? Well, I use it differently than what you saw here. Geksky and Samanoff have a paper in which they track the performance of all different types of assets with respect to momentum. They looked at geographically diversified stock indices, stocks themselves, commodities, currencies, fixed income, and they found that geographically diversified stock indices outperformed them all. That was before trading costs. So I prefer to be with what works best, and there is no real trading cost issue. The model in my book, the GEM model I showed you today, it trades about 1.5 times a year. In terms of factor investing, is it more efficient in intraday or short-term trading? I've never seen anyone look at factor investing with respect to short-term trading, except perhaps momentum in terms of trend following. So, and I think I've shown you what should be done there. In fact, I had an interesting experience back in the early 90s. I wanted to do some short-term trading and follow the trends that way. And there were no Python libraries or, in fact, data was really hard to get. So the only thing you could use was TradeStation. And this was before I knew any better. I holed up in a room for a long time, many months, and started developing all these short-term strategies with TradeStations. And I'd hold out data, to validate. And invariably, whatever looked good would turn into doo-doo. And it was because I was looking to use trend following on a short-term basis. And also I was overfitting the data. Can you compare market behavior from early 1900s to now when there are more trades that are algorithmic? Well, some people ask about, high frequency trading, and yes, they do take a little bit from the market, but they do what stock exchange specialists used to do. They take a little bit in order to provide liquidity. Market behavior is a interesting question from the early 1900s to now. Back in say the 1930s, things were different. And I know it's always dangerous to say this time things are different, but they really were. Back in the 1930s, governments didn't know what they were doing. In fact, during the Great Depression, the government tightened up. They did the opposite of what they probably should have done. There were no safety nets or safeguards. They allowed the banks to fail, etc. And there really was no globalized trading prior to the 1950s. There were restrictions on capital flows. So you have to kind of draw a line somewhere. And I think post-World War II is a good place to do that. If zero or negative interest rates become the new normal for the next decade or so, would you recommend using cash instead of bonds? Yeah, if you have a crystal ball and know that for sure, of course. You don't want to have a negative interest rate like Japan had, but that's pretty improbable that you would have a negative interest rate. I actually apply dual momentum to the fixed income market in my proprietary models, and we have a lot of flexibility on where we are in terms of how we approach fixed incomes. Is there any evidence that optimal look-back window is a function of volatility? The problem is, how do you measure that over what period of time to where it's meaningful? I haven't seen any studies on that. And again, if you're going to complicate things, there's always a danger of data mining as well. So I'd want to see a reason why that might be the case. You can make a case, I think, that when you have more volatility, you want to give your positions wider berth. And when you have less volatility, perhaps tighten it up. That's done by technical analysts. They use average trading range stops and so forth. But I haven't seen any studies with respect to look-back window. I think what I prefer to do is to have something that is not the best all the time and not the worst, but that is consistent and persistent over time. Do you assess quantitative strategies in an after-tax basis? Is there a framework for doing that? It's good to do that, but it's very difficult because everyone's tax situation is different. Retirement plans, of course, have no tax liability, and taxes change over time. So what I found just looking back at the GEM model I have in my book is that it's pretty tax efficient. Over 70% of the gains are long term. If I were to use shorter look backs, that wouldn't be the case. What people also don't consider is that even in ETFs, which are said to be tax efficient, you still pay taxes on your dividends. And over time, about 40% of the return from the S&P 500 index has been in dividends. So there's not much you can do about that. It's going to show up no matter what you do. If you use both the 6-month and 12-month look backs, would you equally weight them? No, I would not. Is diversifying amongst multiple strategies a good idea? Well, sure. If you find strategies that are both really good, sometimes you'll find a strategy that just dominates so much everything else that you may want to put most of what you have in it. But the principle of diversification is always a good one. Even diversifying a little bit can help with overall portfolio as well as your peace of mind. How long will it take until the major factors driving factor indexing disappear to the effect of herding? Well, some academics think it already has. There's a bunch of research out there, but you have to think about that. With all the money coming into factor investing, it's projected to be $2 trillion before long. Everybody doing the same thing at approximately the same time is bound to have some impact. It's like 20 people all trying to go through a door at the same time. Now, where that will occur, nobody can say exactly. But it is something to be cognizant of. What bonds do you compare S&P 500 against for the look back? 3, 6, 9, or 12-month Treasury bills. Okay, for determining the trend, which is absolute momentum, sometimes called time series momentum, I look at the excess return, which is what is the return of the S&P 500 been over the past 12 months versus the return of the risk-free rate, and the best proxy for that is a short-term T-bill. So I'll use a 1 to 3 month T-bill. It's easy to get data for that. ETF symbol is BIL, and Merrill Lynch has the index data going back quite a ways on that. All right, let's see if there are any other additional questions. Do you think strategies mean revert? So investing in otherwise solid, well-tested strategies that have underperformed in the last year or two? It depends on the strategy and how tied in it is. Now, underperformed the last year or two, that's where we get outside of the range of mean reversion. So if you're talking about underperformed for the last 3 to 5 years, you can make a case for that. In fact, pension consultants do the opposite of what they should do. In advising strategies to their clients, they'll often look at performance over the past 3 to 5 years, and they'll weed out the poor performers and replace them with good performers. That's the opposite of what they should do, and research has shown that, because stocks mean revert in a 3 to 5 year window. As far as maybe when to invest with a strategy, if it's a stock-based strategy, after a down month, providing we're not in a bear market, that's probably a good time to jump in if you want to try to time it short-term wise. Take advantage of mean reversion on a short-term basis. Is Elliott wave theory investing nonsense, or is there something to it? Okay, Elliott wave is it's basically 5 waves. You have your primary waves up and your reactionary waves. And I looked into it at one time, And it's interesting, but I've never seen a rigorous study done of it. It's really hard to do because you have to determine when and where those waves are and what time frame you're looking at. So it's one of those nebulous things. Uh, it's not for me. What effect do you see the current level of huge debt load having upon the markets? It doesn't seem to be having much effect. Um, you have to look at not just debt by itself when you consider what's going on. I mean, corporations all have, well, not all of them, but many of them have large levels of debt. The question is whether they can service the debt effectively without causing other problems. Now, there may be some problems down the road if we have a very high level of debt relative to GDP, but we'll have to see what counterbalancing things occur to that. Can there be a very long period, say a decade or more, when GEM might underperform, buy and hold? Sure. Anything can underperform for a long period of time, too. You just have to have confidence and understand why. The reason why GEM might underperform, buy and hold for a long period of time is if you have a steady rising move up in US stocks, let's say. And we've had something like that since 2009. Then what will happen is you may get occasional whipsaws along the way. So you're going to, any technical approach is going to underperform, buy and hold then. Also, you don't have the advantage of relative momentum where you go from US stocks to non-US stocks if only US stocks are strong during that period. So you just have to ask, how realistic is that to happen in the future and to continue happening? And to my way of thinking, it does happen, but it's not anything that would dissuade me from investing this way. Are you working on any new book or follow-up to Dual Momentum? I do plan on coming up with a new book. There's been a lot of research done over the last 4 years since my book was published. And I like to incorporate that as well as incorporate all the questions I get asked, many of which are on the FAQ page of my website. Also, I'd like to make it a little clearer and easier for people to implement dual momentum.
All right, so I think that's the end of the questions for now. We're gonna have to wrap it up, but if you had a question for Gary that wasn't answered, you can send it to us at events@quantopian.com, and we will pass those along to him, and hopefully he can provide you with an answer. You're also feel free to continue this discussion in the Quantopian forums. I want to thank Gary for an excellent presentation.
Thank you, Paige.
All right, thanks everyone for attending. Have a nice day.